Most traders fail at futures for the same reason people skip the instructions when assembling furniture. They assume knowledge is optional. But here, skipping the instructions costs real money, and fast. By the end of this video, you'll know how to map out the key steps before entering a trade, choose the right order types to execute with control, and build a simple risk management plan that protects your account from avoidable mistakes. Here's the roadmap: education, contract specs, orders, paper trading, and live trading. Paper trading just means practicing in a simulator. You get the feel of how orders, ticks, and balances move without risking cash. That practice builds confidence before your first real trade. I'll hand you this roadmap step by step so your first futures trade becomes a building block, not a breakdown. But before we build, you need to see why most beginners lose money almost immediately. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about how most futures traders fail and how you can succeed. The trap most beginners never see coming is that they walk into the futures market assuming it works just like stocks. On the surface, that seems reasonable. Both involve speculating on price movement. But in reality, treating them as the same is one of the fastest ways to burn a trading account. Futures have unique mechanics, obligations, leverage, and daily account settlements that punish misunderstandings almost immediately. A stock is ownership in a company. You pay for the shares and can hold them indefinitely. An option is the right, but not the obligation, to buy or sell at a given price before expiration. Futures are different. They are standardized contracts that legally obligate the buyer and seller to transact at a set price and date unless the contract is closed early. That obligation, unlike the flexibility in stocks or options, means that once you enter, you're on the hook until you act. Many beginners miss this shift from ownership or rights to obligation, and it changes everything. Another hidden mechanic is daily mark-to-market. With stocks, a 5% drop in price today might sting, but you can hold the shares for years without being forced to act. Futures don't give you that breathing room. At the end of each trading day, gains and losses on open positions are settled in cash, automatically credited or debited from your account. If losses push your balance below the broker's maintenance margin, you'll receive a margin call requiring you to deposit more funds right away. Fail to meet that call, and the broker closes your position, often at a loss. That process, combined with the use of leverage, is how traders can go from confident to wiped out in just a few sessions. Leverage is the accelerant in this equation. In most futures markets, you are controlling assets worth far more than the cash you post up front. For a clear example, look at the E-mini S&P 500 contract. Each contract is worth $50 times the index level. If the index is at 5,000, that single contract represents $250,000 of market exposure. Yet the margin required to trade it might be less than $15,000. On paper, it looks like huge efficiency. You're controlling $250,000 of exposure with a small fraction of that cash. But a 1-point swing in the index equals $50 in profit or loss. A 20-point move translates to $1,000. These seemingly modest price shifts can escalate quickly and overwhelm underfunded traders. Imagine a hypothetical beginner who treats buying an E-mini as if it were buying a handful of company shares. They see the margin requirement, assume it's like a down payment, and enter without planning. Overnight, the market drops 30 points. That's a $1,500 hit immediately deducted from the account. If their account was lightly funded, this single move could trigger a margin call or even close them out. They didn't necessarily have a bad idea on price direction. The failure was underestimating how quickly losses compound under futures rules. The leverage and margin dynamic is often misunderstood. Margin in futures is not a discount on buying, it's a good faith deposit to guarantee performance on the contract. When losses reduce that cushion, the broker requires you to replenish it. It's not optional and you don't get to decide when. That sudden pressure is what catches unprepared traders off guard. Here's a practical step. Before placing any futures order, always check the initial margin and maintenance margin for that contract. Ask yourself, am I comfortable funding a margin call if the market moves against me? If the answer is no, you shouldn't be in that position. Think of leverage and daily settlement like a power tool with an exposed blade. In skilled hands, it's efficient and precise. In untrained hands, it can cut you badly before you even know what happened. Futures can magnify gains, but the same mechanics magnify losses, faster and with less room to react compared to stock trading. The structural difference with options adds another complication. If you buy an option and the market goes against you, the most you lose is the option premium. You can walk away. Futures don't offer that escape. If you hold a contract, you are committed until you exit or it expires. That weight should shape how you build your strategy, because without predefined exits, every trade becomes a gamble where the clock is working against you. And that brings us to the core mistake beginners make. They focus entirely on predicting direction, up or down, while ignoring the necessity of setting exit levels and managing risk. Without defined stops and position sizing rules, emotions take over. Lose a little and you're tempted to hang on just a bit longer. Win a little and you're tempted to close early, fearing it might slip away. This cycle of second guessing drains accounts as surely as bad calls on market direction. The smartest time to plan your exit is before you ever click buy or sell. Once you're in a position, the mix of pressure, money on the line, and market speed makes clear decision-making difficult. Pre-trade planning allows you to calculate risk per contract, set protective stop levels, and define conditions for closing. That discipline doesn't eliminate losses. Losses will happen, but it stops them from spiraling out of control. Survival in futures trading depends less on finding the perfect entry signal and more on staying intact long enough to gain experience. So here's the takeaway. Futures are not built to forgive ignorance. They're structured with leverage, daily settlements, and legal obligations that demand preparation. Beginners stumble because they assume futures work like stocks, but the mechanics can empty an underfunded or undisciplined account almost overnight. Now that you understand the trap, your next step is to learn exactly what information each contract contains. Because buried inside every futures contract sheet are specifications, the blueprint of what you're really trading, and overlooking them can cost you thousands. Before you can place a single futures trade, you need to decode the contract itself. Every contract has its own set of specifications, and those details determine exactly how much you're risking, how your profits are calculated, and what obligations you may face if you hold it too long. Skipping this step is how beginners get surprised, not by the market's direction, but by the mechanics of the instrument they chose. The first specification to learn is contract size. This tells you the quantity of the underlying asset one contract represents. A gold futures contract equals 100 troy ounces, while a crude oil contract equals 1,000 barrels. For a financial example, the E-mini S&P 500 index contract is $50 multiplied by the index level. At an index level of 5,000, one contract controls $250,000 of exposure. Many beginners mistakenly believe that because the word mini is in the name, the risk must be small. In reality, it still ties you to hundreds of thousands of dollars of market value. Next is tick size and tick value. A tick is the smallest increment a contract can move. For the E-mini S&P 500, the tick is 0.25 index points. Using the exchange's official spec sheet, the math works out like this. Contract size equals $50 times index. Tick size equals 0.25 points. Tick value equals $12.50. That means every quarter point move up or down changes your account by $12.50 per contract. A 10-point decline equals 40 ticks, which equals a $500 loss. A 100-point move? That's $5,000 on one contract. The shifts may not sound big until you translate them into the real money impact. To picture this, think of ordering a drink without checking the menu. You ask for a Coke, expecting a glass, but the server rolls out a giant pitcher. Without looking, you had no clue about the size. Futures contracts work the same way. Names like E-mini or micro don't reliably tell you the actual financial scale. Only the contract spec sheet explains how much you're committing each time the market moves one tick. Expiration and settlement rules are another critical part of the blueprint. Unlike stocks, which you can hold indefinitely, every futures contract has a last trading day. After that, it either cash settles or delivers the physical commodity. Cash settlement is common in financial futures like stock indexes. At expiration, your account is credited or debited based on the difference between your trade price and the final settlement value. Physical delivery is more common in raw materials like grain or energy. If you held a crude oil contract through expiration, you'd be responsible for 1,000 barrels of oil. Most traders don't want to deal with tank storage or delivery logistics, which is why they close contracts before expiration. The bottom line? You're either exiting before the deadline or accepting whatever the settlement method demands. Trading hours and liquidity also matter. Some contracts trade nearly 24 hours, pausing only for short breaks. That means if you enter a position and go to sleep, overseas news can move the market against you while you're offline. The E-mini S&P 500, for example, has trading sessions that extend almost around the clock. Knowing the hours helps you manage when you're comfortable holding risk. Contract months are equally important. Some products don't trade every month, but instead only in quarterly cycles like March, June, September, and December. If you choose an off month, you could end up in a thinly traded contract with low liquidity, which makes prices less stable and can widen the cost of entering or exiting your position. A pair of missteps appear again and again among beginners. One is underestimating contract size, thinking a single position is small when it can represent hundreds of thousands of dollars. The other is overlooking tick value. A 1-point move in the E-mini equals $50, so a quick afternoon swing of 10 points is already $500 against you. Both mistakes come from not reading the specs. Without those numbers, you risk taking positions far bigger than your account can handle. Here's the actionable step. Before you even think about sending an order, open the contract specification sheet from the exchange. In the US, that's often the CME Group website, or check your broker's contract information page. These sheets list the contract size, tick value, trading months, last trading day, and settlement method. They're free, updated by the exchange, and designed so traders can avoid the exact mistakes we've been walking through. Spending 2 minutes looking them over can save you from thousands of dollars in unwanted risk. When you know the specs, you gain control. You can size positions properly, you can plan exits before deadlines, and you can calculate exactly how a tick translates into real money. Traders who make contract specs part of their process treat futures as a tool they understand, not as a gamble they hope will work out. Understanding contracts is only one pillar. The other is knowing how much money you actually need in your account to support those trades, and that's where margin comes in. Many beginners assume margin is just a down payment, like borrowing to buy stock. But in futures, the meaning is completely different. And that misunderstanding is the next reason so many accounts are wiped out early. Margin in futures trading sits at the center of both opportunity and danger. Yet it's one of the most misunderstood parts of the market. Many new traders treat margin as if it's a partial payment on an asset, the way stock margin works, or the way a down payment works on a house. In futures, that mindset backfires. Here, margin is not prepayment for ownership, it's a performance bond. It exists to prove you have enough funds to cover potential losses as they happen. Once you shift your thinking to that definition, the way you look at risk changes completely. Let's define the pieces step by step. The first requirement you'll meet is called the initial margin. This is the minimum deposit you must put aside to open a position. It's not buying the asset outright, it's simply giving the exchange confidence that you can bear losses if the market moves against you. After your position is open, the second piece comes into play, the maintenance margin. This is a lower but critical threshold. It represents the minimum balance you have to keep in your account to hold that trade. Now here's the important sequence that catches beginners off guard. If your account balance falls below the maintenance margin because the market moved against your position, you'll receive a margin call. That call means you must deposit additional money to bring your account back up to the initial margin. Fail to do that, and your broker will close your trade automatically at the current market price, whether or not it's favorable to you. In short, the margin call forces action. You don't get to ride things out indefinitely. Consider one example with contract specs we've already seen, the E-mini S&P 500. Each contract represents $50 times the index, so if the index is 5,000, the exposure per contract is 250,000. The exchange margin requirement might be only a fraction of that value, but the risk still spans the full $250,000. If the market moves just 1 point, your account changes by $50 per contract. Let's say you're holding one contract and the market falls 20 points. That's a $1,000 hit deducted through the daily settlement process. If your margin deposit was $10,000, your account just dropped by 10% in a single day. You can see how modest price swings translate into meaningful account shifts. This is where leverage steps in. Leverage in futures means that the money you post up front gives you control of a position many times larger than your deposit. With that E-mini example, controlling $250,000 of exposure with a much smaller margin deposit creates a kind of multiplier. Gains can multiply quickly, but losses do the same. A 1% move in the index could translate to a far larger percentage change in your trading capital. That magnifying effect is powerful, but it's also the reason traders underestimate how quickly risk compound. Market volatility adds another layer. Margin requirements aren't fixed forever. Exchanges can raise them at any time, especially when conditions get unstable. During periods of calm, the exchange might require relatively modest levels of initial margin. But if volatility spikes, those requirements can double without much notice. That means even if your trade is profitable, you might still face a margin call because the exchange raised the bar. Many traders are surprised, and sometimes knocked out, not by price movement, but simply because the new rules demanded more funds overnight. The lesson here is simple. Don't assume today's margin requirement will apply tomorrow. Think of margin as insurance money, not buying power. It's protection for both sides of the trade. The best mindset is to respect margin as a guardrail, not as a license to stretch positions as far as you can. When you see the deposit as insurance, you naturally size trades in a way that leaves room for swings, for new requirements, and for unexpected volatility. And that room is what keeps accounts alive when the market turns. Another point beginners often overlook is that losses can exceed your initial margin. Because of the leverage involved, if the market moves far enough against you, your losses might be larger than your deposit. That leaves you with a debit balance, an obligation to your broker that must be covered. It sounds harsh, but it's the natural result of trading obligations with borrowed exposure. This is why professional risk managers always recommend keeping extra funds in the account as a buffer. Here's a practical takeaway. Before placing any order, check the current margin requirement on your broker's website or the exchange. Requirements change with volatility, and you don't want to be caught underfunded. As a safeguard, always maintain more cash in your account than the minimum. That buffer is what covers sudden margin calls and prevents forced liquidation during volatile markets. It's not just a best practice. It's the difference between staying in the trade long enough to manage it and being forced out on someone else's terms. Put simply, the danger zone around margins comes from misunderstanding. Treat margin as a sign of how much exposure you're truly taking on, not as a cheap way to buy more. Respect the leverage, plan for maintenance calls, and recognize that rules can shift when volatility spikes. This perspective reframes the market from a tempting shortcut into a place where preparation decides survival. Now that you know how margin works and why it's so often misread, the next challenge is choosing where to apply that knowledge. Not every futures market plays by the same rhythm. Some are structured enough for beginners to learn without being overwhelmed, while others can punish inexperience almost instantly. Knowing which battlefield to step onto first can make the difference between a manageable entry into futures or an early exit. So how do you decide which futures market to begin with when you're just getting started? This step matters because different contracts carry very different risk levels, and some are structured in ways that make them far more manageable for learning. Picking a market at random is like stepping into a sport without the right safety gear. You might survive, but the odds are tilted against you. Futures cover almost every major part of the economy. On one side, you'll find commodities like corn, wheat, crude oil, natural gas, and metals such as gold and silver. On the other side are financial contracts, currencies like the euro or Japanese yen, stock index futures tied to benchmarks like the S&P 500 or NASDAQ 100, and interest rate futures linked to treasury bonds. Each of these areas has its own pace, volatility, and liquidity. That's why the experience of starting in a large stock index is very different from starting in crude oil or natural gas. Energy markets, for example, often look tempting because they dominate headlines and seem full of opportunity. But commodities like crude and natural gas can produce very large dollar swings per contract. The volatility is intense, and small accounts may not withstand those moves. What beginners read as fast profit potential is usually just sudden exposure to losses that far exceed their comfort zone. That's where a clear checklist helps. The 4 criteria to use when choosing your first market are straightforward. Liquidity: pick a contract with heavy daily volume so your trades can be entered and exited without hidden costs. Volatility: choose a product with moderate movement. Too little and you can't learn much. Too much, and losses stack up fast. Contract size: start with smaller contracts so each tick does not have an outsized effect on your account. Ease of understanding: trade something you can follow without advanced expertise. Stock indexes are easier to grasp than energy supply models or agricultural weather cycles. Let's apply that checklist to 2 different examples. The E-mini S&P 500 is built around the broad US stock market, an index most beginners already track. It offers deep liquidity, steady participation from both institutional and retail traders, and price movement that reflects market sentiment rather than weather or storage capacity. That structure makes it relatively straightforward for someone new to futures. Many exchanges and brokers now also offer micro versions of these contracts, which are smaller in size. Micro contracts usually lower the tick value, making them more accessible to new traders. The exact specifications vary, so always confirm details on the exchange or with your broker before using one. By contrast, a crude oil futures contract represents a massive underlying position, and with its volatility, the daily dollar swings can overwhelm beginners. Both may be futures, but the risk profile is miles apart. Think of your first market as a training ring. You don't start martial arts sparring with bare knuckles, you begin with gloves and pads. Micro contracts, when available, are like those pads. They let you practice strategy and psychology in a controlled environment. Jumping into crude or natural gas, on the other hand, is more like climbing into the ring unprotected against a heavyweight. The odds of walking away discouraged, or worse, with a blown account, are high. There's also a lesson in context. A smaller contract size isn't always a safe contract. If the market itself has thin liquidity, price jumps can still be unpredictable and severe. That's why you want both modest size and consistently strong participation from other traders. When you put those 2 pieces together, risk becomes more manageable and you focus energy on building skill instead of fighting the market structure. Transparency matters too. With stock index futures, you can see the index value in real time, and you often already understand the broad forces moving it: economic reports, earnings, and market sentiment. Compare that to an agricultural contract where pricing may rely on hard to follow data like rainfall in South America or sudden government export restrictions. The clearer the forces are behind price movement, the easier it is to practice without being thrown off balance. So, here's a simple filter to use. Find a liquid contract with lots of participants. Keep the contract size small enough that every price tick doesn't stress your account. Stick to markets with moderate and steady volatility. And pick something you can follow easily with publicly available information. That combination points many beginners toward index futures like the E-mini S&P or its micro counterpart if their broker offers one. The practical takeaway: start small, keep it understandable, and don't let excitement about big moves push you into unstable markets early on. Early trades should feel like structured practice, not roll the dice bets on the news cycle. The marketplace has room for wild speculation, but your first stage in futures trading isn't about making headlines. It's about survival and preparation. With the groundwork of choosing the right market in place, your next challenge is handling the mechanics of how you enter and exit those trades. Because even if you pick the perfect contract, using the wrong type of order can still turn a decent idea into an expensive mistake. Orders are the invisible gears of trading. They decide not just when you enter or exit, but how those moves translate into real account results. Knowing the difference between order types turns trading from guesswork into a controlled process. Misusing them, on the other hand, can undo even a solid trade idea. Start with the market order. A market order is straightforward. You're buying or selling at the best available price right now. The main advantage is certainty of execution. You're in, no waiting. The drawback is slippage, which means you might get filled at a worse price than you expected. In a highly liquid market like the E-mini S&P, that slippage is usually small. But in thinner markets, a market order can slip multiple ticks, making what looked like a small risk much bigger. Best practice: avoid market orders in contracts with low liquidity, and only use them when speed of execution matters more than price. Next is the limit order. A limit order means you control the maximum price you're willing to pay on a buy or the minimum you'll accept on a sell. The upside is price control. You won't pay more or receive less than your number. The downside is non-execution. If the market never touches your price, the trade won't open or close. A helpful tip: use limit orders when precision matters, but always remember the trade-off. You might never get in. Then comes the stop order, also known as a stop loss when used defensively. A stop order activates if the market hits your chosen price, then becomes a market order. Traders use them to cap downside risk or lock in gains. For instance, if you go long at 4,000 and place a stop at 3,990, your position will close once that level is hit. Stops don't guarantee that exact price. They guarantee an exit. If the market moves quickly, you may close a few points beyond your stop. That's slippage again. The golden rule: always place a protective stop as soon as you enter a position, or use one cancels other OCO instructions if your platform allows. So risk is controlled from the very first moment. Stop limit orders blend both worlds. Once the stop price is reached, the order becomes a limit order. This gives you price protection. You won't be filled at worse than your limit. But there's a catch. If the market races past your limit, you don't exit at all. That leaves you in a trade you meant to close. Slippage means you get a worse fill than expected, while non-execution means you don't get out at all. Knowing the distinction can save you from a nasty surprise. Another tool is the MIT, or market if touched order. Think of it as the opposite of a stop. A buy MIT sits below the market, a sell MIT above. If the price touches your level, your order fires off as a market order. Traders use MITs to take advantage of price rebounds. For example, to get long only if the market dips to a target spot. MITs are less common, but they can be effective for strategic entries. Now let's piece these together in a structured setup. Imagine you want to practice with a liquid index future. The market trades near 4,000 and you plan entry on a small dip. You set a limit order at 3,995 to buy only if the pullback occurs. Before you even enter, you define risk. Your stop sits 10 points lower at 3,985. If each point equals X dollars, depending on the contract, you calculate that loss as, say, 1% of your account. On the other side, you place a target limit at 4,015, 20 points above your entry. Now your full play is mapped: a controlled entry, a capped risk, and a clear profit target. Every part of this setup tells the platform what to do, so you aren't making emotional decisions in real time. Notice how each order type serves a function. The entry limit ensures the trade only begins at your chosen spot. The stop loss sets your maximum risk from the outset. The target limit secures your plan to exit with gains. Together, these free you from watching every tick and reacting impulsively. The work was done ahead of time, and the orders enforce discipline. The real danger is mismatching order type to situation. Use a market order in a thin contract, and you may instantly be filled worse than expected. Swap a true stop loss for a stop limit in a crashing market, and the limit may never fill, leaving you exposed as losses spiral. These errors are common, but preventable if you understand how each order behaves. Think of order types like instructions to a driver. A market order is go now, I don't care where I end up. A limit order is take me only to this address. A stop order is start driving once traffic hits this point. A stop limit is start then, but only if the fare stays under my budget. And MIT is if that shortcut road opens, take it right away. The precision of your instructions determines whether you arrive safely or not at all. Here's the bottom line. Order choice isn't a minor detail, it's the backbone of your risk plan. Traders who always anchor entries with defined stops and reliable exits remove much of the emotional chaos from the process. Those who don't end up relying on luck, and luck is not a strategy. There's one final best practice. Before risking money, test these order types in a paper trading account. See how they trigger, how slippage shows up, and how OCO brackets behave. Platforms execute differently, and practicing without real money gives you confidence before stepping live. Once you've seen how orders enforce discipline, the next step is tying everything together. You've learned about traps, specs, margins, markets, and orders. Now the challenge is to assemble those pieces into a clear, repeatable checklist you can use when placing your very first real futures trade. Let's walk into the practical part, the exact blueprint for your very first trade. Think of it as the pilot's pre-flight checklist. Each switch gets flipped in order so you're not improvising at 30,000 feet. The purpose isn't to remove risk. That's impossible. The purpose is to replace guesswork with a structure you can follow every single time. Step 1 is paper trading. Start here before risking any real capital. A paper account lets you practice in live markets using simulated money. You'll see how ticks convert into gains or losses, how orders really execute, and how margin requirements show up in your account screen. It won't teach you the psychology of losing real money, but it will give you command over the platform so mistakes don't come from clicking the wrong button. Build a habit here. Run multiple paper trades until you can consistently set entries, stops, and profit targets without hesitation. And take this one step further. Use your paper account to watch how margin calls would have affected you. Pretend you actually had to fund the call. That rehearsal matters because margin stress is where many traders fold. Step 2 is contract selection. Choose something liquid, straightforward, and appropriate in size. For most beginners, major stock index futures like E-mini or micro-size versions are better than volatile commodities. They offer steady liquidity and transparent price drivers. Avoid thinly traded or hard-to-follow contracts like natural gas or agricultural products when you're new. Your goal isn't chasing headlines, it's practicing execution in a calm environment. Step 3 is reading the spec sheet. You already know every futures contract carries its own rules. The spec sheet shows the contract size, each tick's dollar value, the trading hours, and the expiration rules. Skipping this is like agreeing to a lease without knowing the rent. If every tick equals $10, but you assumed it was 1, that misunderstanding can drain your account faster than price direction. Always confirm the scale before placing an order. Step 4 is defining your entry, stop loss, and profit target in advance. Never buy first and plan later. Ask, what exact price triggers the entry? At what price will you admit you're wrong and exit? And what target makes the risk worth the trade? Those 3 decisions stop you from improvising once the market moves. Remember, a stop loss isn't optional. It's your only guarantee against letting one small red trade turn into a disaster. Place it logically, either beyond a recent price level or at a distance that aligns with your risk tolerance. A written target on the other side locks in discipline, so you don't let greed or doubt tear up your own plan. Step 5 is position sizing and risk per trade. This is where the math protects you. A core guideline: never risk more than 1% of your trading capital on a single trade. If you have a $10,000 account, your cap is $100 per trade. Work backward. First, decide your stop distance. Maybe it's 5 points. Multiply that stop distance by the contract's dollar value per point. If the answer is greater than $100, you take fewer contracts. If it's smaller, you know how many you can hold. This isn't about maximizing size. It's about preserving your ability to take 20 trades in a row without blowing up. Losing streaks happen. Position sizing ensures you survive them. Step 6 is setting your orders immediately. Build the habit that once you enter a trade, your protective stop and your take profit go live at the same time. Many platforms call this a bracket or OCO order. One cancels the other. That way you aren't relying on emotions mid-trade. If the market hits your stop, you exit automatically. If it reaches your target, you get paid automatically. What you never do is leave a position open with no defined risk. Step 7 is writing behavioral rules for yourself. Trades don't just fail one by one. They fail in streaks. A professional plan includes safety breaks. For example, Stop trading for the day if you hit 3 consecutive losses, or if your account drops by a certain percent. Some traders reset back to paper after a losing streak to rebuild confidence. The exact rule is yours to define, but what matters is having it in writing before the losses come. Following your own stop trading rule is what keeps frustration from leading to revenge trades. After these 7 steps, there's one more critical piece: review. Every trade, whether paper or live, deserves a short record. Write down the entry, the exit, whether you stuck to your plan, and what emotions came up. Over time, that journal exposes patterns. You'll see if you keep moving stops, hesitating on entries, or trading out of boredom. The review process is what transforms the checklist from a one-time tool into a system that improves with you. If you're disciplined enough to follow these steps, your first real trade won't be about how much you made. It'll be about whether you executed the process as designed. That shift in focus from fast wins to structured practice is how you separate yourself from the majority who lose early. Here's the bottom line. Beginners don't need to master prediction. They need to master consistency. Your first trade blueprint is less about trying to be right and more about proving you can survive and repeat the process. Carve these habits in now, and you build the foundation for long-term trading. And this brings us full circle, because most traders who fail aren't failing from bad ideas. They're failing because they skipped the roadmap entirely. Here's how to keep your first steps in futures controlled instead of costly. 3 actions form the core blueprint. First, paper trade until you can place entries, stops, and targets without hesitation. Second, read every contract spec and confirm both the tick value and the margin requirements. Third, define entry, stop, and position size in advance. Never risk more than 1% of your account on a single trade and enforce that plan with actual order placement. Only trade with capital you can afford to lose. Futures can generate losses larger than your initial margin. If this roadmap helped, like and subscribe, and comment the first contract you're considering. Remember, survival is the starting line, and repeating this checklist with discipline, not improvisation, is what keeps you trading tomorrow.